Welcome back, Market Rebels! Well, last week we found out about the Peltzman effect and why, if you're trying to reduce risk, you may end up increasing it. Today you'll find out why traders who try to tame the market through technical analysis actually end up training it to work against them. Reflexivity, the market strikes back. Traders often think markets are something to be tamed, like a dog at an agility course. If they can just get better commands, better signals, and tighter rules, the market will finally jump through the hoops. Sit, stay, respect the trend line. At a stop loss, hedge with options, optimize the model, and surely the chaos will behave. It's a belief deeply etched in trading culture. Every new indicator promises clarity. Every risk tool promises control. Every refinement suggests that uncertainty can be engineered away with enough sophistication. The market only appears unruly and chaotic, but it's ultimately submissive, a system waiting to be disciplined by smarter rules and sharper tools. But markets aren't obedient pets. They're not even trainable ones. They're adaptive systems populated by other traders doing the same thing and sharing the same beliefs. Don't enter the dog trainer, enter reflexivity. Reflexivity is a term coined by the legendary investor George Soros, founder of the Quantum Fund, which became one of the most successful hedge funds in history. Reflexivity is the idea that market participants are not external observers of a system. They're part of it. Their beliefs, rules, and strategies feed back into prices and behavior. The market doesn't merely respond to fundamentals or random noise. It responds to how people interpret, manage, and attempt to control risk itself. In a reflexive system, controls are never neutral. They change behavior, and change behavior changes outcomes. Unlike traditional investors who relied heavily on valuation metrics, Soros focused on how perceptions, policy constraints, and capital flows interacted dynamically. His fame skyrocketed in 1992 with one of the most famous macro trades in history. The British pound trade, breaking the Bank of England. In 1992, the United Kingdom was part of the European Exchange Rate Mechanism, ERM, which required the British pound to trade within a fixed band against the German Deutschmark. The peg was politically motivated but economically fragile. Britain faced higher inflation, weaker growth, and interest rates that were too high for domestic conditions. Defending the peg required the Bank of England to raise rates and buy pounds, but those actions worsened the economy, undermining confidence in the currency. Soros recognized a reflexive loop. Intervention weakened fundamentals, weaker fundamentals reduced credibility increased speculative pressure, and increased pressure forced even more intervention. Soros shorted the pound aggressively. As pressure mounted, the Bank of England spent billions defending the currency and raised interest rates twice in a single day. Ultimately, the defense failed. Britain exited the ERM, the pound collapsed, and on September 16, 1992, Black Wednesday, Soros cemented his reputation as a legendary financier by netting $1 billion in a single day. That was not a bet on a static mispricing. It was a bet on a self-reinforcing feedback loop between beliefs, policy constraints, and market behavior. Traders rarely take this feedback loop idea, reflexivity, into account. They make the mistake of treating tools as if they exist outside the system. A stop loss is assumed to reduce risk. A hedge is assumed to neutralize exposure. A model is assumed to describe reality. But once these tools become widespread, the market adapts to them. Liquidity shifts, volatility migrates, correlations change. The very behavior the tools were designed to control begins to reappear, just in a different form. Markets aren't being trained, they're learning. The market doesn't resist control out of spite. It adapts for survival. Traders who treat markets like a trainable dog ultimately fail. Once you understand reflexivity, you'll see it everywhere. It applies anytime you have feedback loops, from stock markets to hoops. Why did basketball players get taller? Years ago in the NBA, a 6'8" center wasn't just good, it was a unique weapon capable of winning games. A few teams had an edge because one player was above the population mean in a way that produced wins. This is exactly what an early market edge looks like. But then, reflexivity breaks through. Once other teams realize that tall centers dominate, they all search for the same. But why stop there? Instead, they say if 6'8" is good, 6'10" is better, and 7 feet is even better. However, once all teams have 7-footers, the advantage disappears. Instead, the distribution shifts. What used to be a better becomes average, and for the pros, average becomes insufficient. In other words, the threshold moves. Edges aren't about being good, they're about being better than the field. A 6'8" center didn't shrink, the field grew. The three-point line appears. By the time all teams had optimized for height, the game became congested near the basket. Everyone was competing in the same high-value area. Height no longer created wins. It just neutralized losses. In reflexive terms, the dominant strategy had been fully neutralized. The game's original dimension collapsed into a bottleneck. In response, the game adapted, and the three-point line was created. The three-point line didn't reward being taller, it rewarded being elsewhere. The game evolved to operate in a new dimension. Teams didn't get rewarded for taller players, they got rewarded for spatial separation and accuracy under low congestion. Because players adapt, rules are constantly changing. The shot clock was introduced to fix stalling and possession hoarding. The defensive 3-second rule was created to fix permanent rim protection. And widening the lane fixed single-player interior dominance. The lane was widened multiple times, which increased the distance big players had to cover, which reduced pure positional dominance. When one advantage breaks the game, the geometry, not the player, is adjusted. If the game didn't adapt, one team with a 7-foot center would have runaway wins. You'd see scores of 200-0. Fans stop going, sponsors move their money, and the game dies. Instead, when optimization collapses the game into one dimension, taller players, the system survives by creating another. In the end, we still see the same scores, just under new conditions. If players continue to get taller, courts will get longer, hoops get raised, and rules get changed. That's reflexivity. The stock market is reflexive. Markets do the same thing for the same reasons. If a stock price rises, it changes traders' perceptions of value. They think it's a great stock, not necessarily because of fundamentals, but because everyone else thinks it is. That causes them to buy, which causes the price to rise further, which confirms their belief that it's a great stock. In other words, the stock's price alters perceptions, which alters decisions, which feeds back into price. This is a reinforcing feedback loop, which explains how bubbles get started. The field gets congested, so traders begin looking for value elsewhere. For instance, traders were extracting too much value from longer-dated options using short-term views. Volatility was being overpaid at long horizons for short-lived information. So the market adapted by introducing weeklies to carve time into finer slices. If traders think, I just need the next 3 days, the market says, fine, here's a contract that expires in 3 days. Pay for only that time. That was the market's way of adding a three-point line. Each migration to a new dimension temporarily relieves crowding, but eventually becomes crowded itself. The business of printing money. Traders often describe selling naked puts as printing money. Well, perhaps naked puts created an edge decades ago. But once the word got out, selling increased. Then the markets got aggregated levels of naked puts, which is like the NBA players crowding the basket. Clearing firms observe short downside risk concentration. Margins rise, prices fall. How far? To a point where it's not an advantage to sell puts. This time we got a balancing feedback loop, which brings prices down rather than reinforcing in the same direction. No matter what you call it, the market adapted. Basketball didn't ban tall players. Markets didn't ban selling puts. Rules aren't about fairness, they're about preventing optimization from destroying the game. Forget following Fibonacci. Fibonacci extensions, fans, and arcs are popular among traders. But if following Fibonacci lines creates profits, the market adapts. It's like saying you have a 6/8 center, so you have an edge. True, but not for long. As long as traders follow these rules, the markets respond. More astute traders simply use these levels to hunt for liquidity, to place stops or other orders. Just when liquidity is needed most, your order is waiting to be picked off at the worst possible time. Just as NBA teams ultimately didn't get rewarded for being taller, the league adapted by creating advantages for being different. For markets, traders don't get rewarded for following well-known technical lines. When everyone believes the same line on the chart matters, the market doesn't argue. It moves the danger somewhere else. In the end, there's just a different market with the same returns. Just like basketball, it's the same game with the same scores, just taller players. That's reflexivity. However, reflexivity doesn't just move to a new equilibrium and stop, it's in constant motion. The Red Queen effect. Sometimes you'll hear the idea of adaptive markets called the Red Queen effect, after a scene in Lewis Carroll's book Through the Looking Glass. The Red Queen tells Alice it takes all the running you can do to keep in the same place. In other words, when the environment adapts in response to your actions, relative position matters more than absolute progress. Everyone must keep changing not to get ahead, but just to avoid losing ground. It was originally used to describe evolution. For instance, some gazelles are slightly faster, so they escape more often and reproduce more. In response, average gazelle speed increases. That means slower cheetahs starve. Faster cheetahs reproduce, and average cheetah speed increases. A new cycle forms new traits, so we can see faster speeds, better endurance, more agility. In the end, gazelles are not safe. Cheetahs are not overfed. Both species ran faster just to stay in the same place. Financial markets have their own similar arms races. A pattern works, traders pile in, but then price adapts. In response, computers became faster and indicators got more complex. Eventually, noise dominates and everyone is running faster just to get the same returns. The pattern didn't stop working because it was wrong. It stopped working because it was right and got exploited. An edge that is enough today is a trap if you mistake it for permanent. The Red Queen effect explains why every profitable strategy eventually turns into risk without reward. If a strategy still works after everyone understands it, you've misunderstood why it worked. Reflexivity doesn't say these tools are bad. It says they're incomplete. Don't think they're a road to easy money. Everyone wants to take that road, but those actions change incentives. Every rule reshapes behavior. Every attempt to stabilize the system becomes part of the system itself. Stability doesn't persist, it invites behavior that undermines it. This is why markets often appear to break right when they are most carefully engineered. Traders only notice this in hindsight. A strategy works beautifully until it doesn't. From the trader's perspective, this feels unfair. The tools worked, the math was right, the model was sound. But they overlooked one thing. The environment changed. The market isn't punishing traders for being wrong. It's responding to their collective behavior. Reflexivity explains why. This is why purely mechanical trading eventually fails. Not because the rules were wrong, but because the system learned them. It tells us that markets cannot be fully controlled because attempts to control become signals. Signals become information, and the information becomes an incentive. For options traders, volatility selling dampens moves until it concentrates risk into rare but violent events. These outcomes aren't accidents, they're adaptive responses. The illusion traders fall into is believing that better tools lead to better outcomes in a linear way. Add more protection, reduce more risk. Add more data, gain more certainty. Add more rules, enforce more discipline. But in adaptive systems, linear thinking breaks down. Sometimes more protection leads to more fragility. Sometimes tighter rules reduce flexibility. Sometimes clearer signals attract crowded behavior. This doesn't mean traders should abandon risk management. It means they should understand its limits. Risk is not something that can be removed from a reflexive system. It can only be reshaped. The market's job is not to reward control, it is to clear trades among participants with different beliefs and constraints. When those beliefs and constraints converge, instability follows. This is why equilibrium is fleeting. The moment it appears stable, behavior shifts to exploit it. Markets don't sit still long enough to be mastered. They respond. They adapt. They strike back, not as punishment, but as feedback. Understanding reflexivity changes how traders think about tools. A hedge is no longer a guarantee, it's a behavioral modifier. A stop loss is no longer just protection, it's a coordination device. A model is no longer truth, it's a hypothesis that influences action. One of the best lessons you can gain as a trader is to stop asking, how do I control the market? Instead, ask a more insightful question. How does the market change when I do this? The question doesn't eliminate uncertainty, but it aligns thinking with reality. Markets aren't agility courses. They don't follow commands. They observe, adapt, and respond. And the moment traders forget that, when they believe they finally trained the system, is usually when reflexivity reminds them who's really learning. It can be a very expensive training class to take. Next time, traders always fear an options time decay, so they turn to selling options as a guard or hedge against time decay. But can you hedge time? Find out the paradoxes and risks that occur if you believe you're hedging time.